Welcome to Talk Tickers. We know you're busy, but you need the bottom line on what's driving the markets. So today, we're diving straight into the Q1 2025 earnings call for First Internet Bancorp. Ticker is FIMB.
Right, FIMB.
Our mission, as always, is to cut through the noise, pull out the key insights, and, well, figure out what it all means for you.
Okay, so for Q1 2025, it's kind of a mixed bag for First Internet Bancorp. Some definite bright spots, but also some areas needing a closer look.
A mixed bag? How?
Well, on the one hand, really strong growth in net interest income. Core revenue looked good too.
Okay, positive momentum there.
Definitely. But on the other hand, we saw an increase, a noticeable one, in net charge-offs.
Charge-offs, where?
Mostly concentrated in their franchise finance portfolio and their small business lending.
Okay. And that wasn't all, right? Non-performing loans too.
Exactly. Non-performing loans also ticked up, driven by, you guessed it, franchise finance and small business again.
All right, let's dig into those numbers then. Net interest income, you said strong. What are we talking?
We're talking $25.1 million for the quarter.
Wow. Okay. And how does that compare?
That's up 6.6% just in the last quarter, Q4. And year over year, a big jump, 20%.
20% year over year. That's significant. And core revenue followed suit.
It did. Strong growth there as well. Like I said, some definite bright spots on the revenue side.
So that top line performance, the net interest income, that's basically the bank's bread and butter, right? Loans versus deposits.
Precisely. It's a core metric. But yeah, we have to balance that against those charge-offs you mentioned. 92 basis points of average loans.
And that translates to?
About $9.7 million. And just for clarity, a basis point is 0.01%. So nearly 1%.
Right. And concentrated in those specific areas, franchise and small business.
Correct. And the non-performing loans also reflecting issues in those same segments.
Okay, so let's unpack that net interest income growth a bit more. You said strong, and I see it's actually the 6th consecutive quarter they've grown NII and core revenue.
That's right. 6th quarter running suggests a pretty solid trend underneath.
And the net interest margin, the NI, how did that look?
Also improved. It went up to 1.82%. That's a 15 basis point increase from Q4.
So what's driving that expansion? Higher rates on loans, lower costs on deposits.
It's really both. They managed to increase the yield they're getting on their loans, and they saw the cost of their deposits start to come down. A good combination.
And looking ahead, management sounds pretty bullish.
Extremely optimistic, actually. They're projecting, get this, a 40% increase in net interest income for the full year 2025 compared to 2024.
40%. Wow. That's ambitious.
It is. And they're also guiding for that fully taxable equivalent NIM to land somewhere between 2.35% and 2.45% by the fourth quarter.
Okay. That's a strong signal for management. Achieving that, though, it really hinges on keeping those deposit costs under control, doesn't it? Especially with the Fed.
Well, who knows what the Fed will do.
Exactly. That's the key variable. It'll be crucial to watch how those funding costs evolve.
Their confidence seems tied to these maturing CDs, right? They expect costs to drop even if the Fed holds steady or cuts rates. Yeah, that's a big part of the story. They have about $1.1 billion worth of certificates of deposit maturing through the rest of this year.
Okay. And the rates on those?
The average cost, the rate they're paying now on those maturing CDs is 4.73%.
And new ones, what are they offering now?
New production is coming in lower, somewhere in the 4.05% to 4.1% range.
Ah, so there's the gap. As the old expensive ones mature, they replace them with cheaper funding.
Precisely. It's a positive repricing opportunity. It should provide a nice tailwind for their NII and margin, assuming rates cooperate, you know.
Got it. Okay, let's switch gears to loan growth. Looked like decent growth in Q1.
Yeah, pretty healthy. About 8% annualized loan growth overall.
And commercial was leading that?
It was. Commercial lending was up around 11% annualized, particularly strong originations in construction and investor commercial real estate.
How strong?
They booked $70 million in new commitments there, and the outstanding balances grew by $86 million. So real activity.
What about the consumer side?
That was actually down a bit. Residential mortgages, home equity balances dipped, and, you know, the usual seasonal decline we see in RV loans.
Anything positive on the consumer front?
Well, they did mention solid originations in their trailers portfolio. These are apparently super prime borrowers, yields in the low 8% range. So good quality there.
And overall delinquencies in consumer, still low.
Very low, just 10 basis points. Suggests their consumer book is holding up quite well from a credit perspective.
And there was a strategic shift mentioned too, right? Towards variable rates.
Yes, that's important. They've been actively shifting the portfolio. Now about 30% of their loan book is variable rate.
Compared to
just 16% 3 years ago. So quite a significant change.
Trying to benefit more if rates go up or manage risk better?
Both, likely. Better positioning for different rate environments.
Okay, deposits also saw some growth, maybe a bit over 2%. What fueled that?
The main engine there was definitely their fintech partnerships.
Ah, the fintech angle. How much growth are we seeing there?
A lot. Deposits coming from those partners jumped 37%, up to $881 million.
Wow. And are these partnerships just about deposits?
No, they're driving huge payment volumes too. $23 billion processed in Q1 alone.
23 billion.
Yep, up 21% from the previous quarter. And that activity generated over $1.1 million in revenue for the bank just in Q1.
So these fintech relationships seem pretty central now.
They really do. It's allowing them to bring in lower cost deposits and reduce their reliance on, say, more expensive CDs or brokered deposits.
Which feeds back into that positive net interest margin story we were discussing.
Yeah, exactly. It all connects. Lower funding costs from fintech plus the CD repricing. It builds that positive outlook for profitability.
Okay, but we do need to circle back to those credit issues. Franchise finance, small business lending, the charge-offs and non-performing loans spiked there. Let's get into that.
Right. So 92 basis points in charge-offs, the 80 basis points in non-performing loans, it's not insignificant.
And they increased their allowance for credit losses slightly too.
Yeah, up 4 basis points to 1.11% of total loans. They also took a higher provision expense in the quarter.
Meaning they set aside more money to cover potential future losses.
Correct. They seem to be proactively addressing the problem loans. Interestingly, they mentioned that $5.8 million of those charge-offs were actually for loans they'd already set aside specific reserves for.
So somewhat anticipated losses then.
Perhaps. Management attributed the rise mainly to borrower-specific issues, not like a whole industry falling apart or a specific region tanking.
Borrower specific. But are there common threads? Is it still a bit concerning even if it's not systemic?
That's the question, isn't it? They do have specific reserves on about a third of the non-performing balance, which offers some cushion. And they sounded, let's say, cautiously optimistic that new delinquencies might slow down in Q2.
Cautiously optimistic. We'll see. Okay, moving on. Non-interest income and expenses. Income was down quarter over quarter.
It was, but the previous quarter, Q4, had some unusually large one-time gains. So the comparison isn't quite apples to apples.
Right, if you strip those out.
The underlying performance wasn't down dramatically. Actually, gain on sale of loans, especially their SBA loans, was up slightly.
Okay. Anything else dragging it down?
Yeah, net servicing revenue was lower because of a negative fair value adjustment. Basically, market changes impacting the value of their servicing rights.
Okay. And expenses. Non-interest expense.
Down slightly in Q1, mainly because incentive compensation was lower, but don't get too excited.
Uh-oh.
They're projecting a 10% to 15% increase in non-interest expense for the full year 2024 compared to the prior year. So costs are expected to climb overall.
Got it. And speaking of SBA loans, there are some changes happening there that might affect things near term.
Yes, exactly. The SBA has made some program changes, things like higher repurchase rates, tweaks to their procedures, their SOP.
And the impact on FIMB.
They expect it to temporarily hit their gain on sale revenue, probably just in Q2. They think it'll be about a one-quarter dip.
Why the dip?
Because they have to adjust their own loan sale process to match the SBA's new rules. And that means holding onto the loans for a bit longer before selling them.
Ah, longer holding period. Is there any offset?
Yes, a partial one. While they hold the loans longer, they'll earn more interest income on them. So that helps cushion the blow to gain on sale a bit.
Interesting how those procedural changes ripple through. Shows you need to be adaptable.
Definitely.
Okay, nearly there. Capital position. How are they looking?
Pretty solid. Tangible common equity ratio at 6.55%. Common equity tier 1, that was 9.16%.
And they mentioned maybe buying back some stock.
They did. They said they might consider share buybacks if the stock price hangs out below 50% of its book value.
Which suggests they think it might be undervalued if it gets that low.
That's usually the signal, yes.
Okay, so let's quickly recap the guidance themes. They expect loan yields up, deposit costs down.
Right, driven by that CD repricing and maybe paying off some expensive broker deposits too.
Loan growth for the year projected around 10-12%.
That's the range, yeah. And deposit growth expected between 5% and 7%.
And the kicker is, if the Fed does start cutting rates again, NII and margin could actually beat these already optimistic projections.
That's the potential upside they highlighted. So, yeah, navigating some credit bumps, but really leaning into NII growth in those fintech partnerships.
Seems like the core strategy. Confidence and profitability despite the asset quality watch items.
That sums it up pretty well.
All right, this is not financial advice. Time for our favorite segment where we toss around some, let's call them outrageous but plausible trade ideas based on all this.
Okay, let's hear them.
Idea 1. We know about that temporary Q2 dip in gain on sale revenue from the SBA changes, right? But management expects it to bounce back. And they floated the idea of buybacks if the stock is cheap relative to book value. So maybe a short play on some other financials that rely heavily on SBA sales. The idea is the market might paint the whole group with the same brush initially.
Okay. Pairing that with
a long position in FIMB itself, you're betting the market overreacts to FIMB's temporary dip, and that its strong NII growth and potential buybacks will lead to a recovery, maybe even outperformance, versus those more SBA-dependent peers.
Interesting. Playing the temporary headwind against the longer-term fundamentals. What's idea 2?
Idea 2 focuses on those fintech partnerships. Clearly a big growth engine driving deposits, volume, revenue. And they expect it to keep exceeding forecasts.
Right. That was a definite highlight.
So maybe a straightforward long position in FIMB to capture that specific growth story. But banking can be volatile, right?
Always. Sector risk is real.
So you could hedge that, go long FIMB, but simultaneously buy some, say, out-of-the-money put options on a broad banking ETF like XLF or KRE.
So you isolate the bet on FINB's fintech success while protecting against a general downturn in the banking sector.
Exactly. Betting on the specific growth driver, but adding a bit of a safety net for systemic risk.
Outrageous but plausible. Fits the bill.
Okay, that wraps up our deep dive into First Internet Bancorp's Q1 2025 earnings call. We've hit the key numbers, the puts and takes, the challenges in franchise finance, but also the promise in NII and fintech.
And management's confidence certainly came through, alongside those potential SBA headwinds and buyback hints.
So what stands out most to you after hearing all this? What questions does it raise for your own homework? Remember, always do your own due diligence.
Absolutely.
Join us next time on Talk Tickers. We'll be back to break down another crucial earnings call, aiming to give you that investor's edge.